investors. I have a great guest today that really covers a lot of time frames. He kind of does it all. Dayan's with us today. Danny's an ex-hedge fund manager. I'm not going to ask you why you're an ex if you don't ask me why I'm an ex-husband. Anyway, Danny, uh, after managing hedge funds, you're now currently a global macro volatility portfolio manager, which is a mouthful, man. So, are you an RIA managing money, or how are you manage? What portfolios do you manage? Are you registered for that, or do you have a fund?
No,
Um,
so I'm currently managing my money, family money as
okay,
well, and some friends as well. It's a very small entity. We're looking at potentially expanding and raising for a new fund. I have a partner that I'm doing that, but very early days. When I
okay,
closed my fund in 2023, I started sharing, my views on Twitter. I was very anti-social media at that
yeah,
point in my life, and in general, I just didn't like Twitter. But
yeah,
I ended up finding it quite valuable for my process around the SVB, the regional banking stuff.
right, yeah,
And so I started sharing my views. And, somewhere along the journey, I realized, it's harder to explain these macro themes and concepts in short tweets and rather than like long form format. So I started the Macro Musings Substack research
okay.
service that I have there, cover both institutional and retail accounts, providing guidance there. And it's gone really well to the point where, feedback has been, why aren't you raising for a fund? And, so I've been, making that contemplation. If I'm
I
ready.
I I want to give you 50 because I need to diversify away from myself. I think everyone should because everyone goes through drawdowns. And if your money is in other competent people's hands, perhaps when you're a little bit cold, someone else is picking up the slack for you. So I just want to talk a little bit about your journey and how you got here. So when did you first know you had an interest in the financial markets? I know you went to Chicago Booth for your MBA, and you're also a CFA. So, did it start in high school, or was it at Booth that you said, these financial markets are fascinating, and I want to play?
Actually, undergraduate studies in Concordia University in Montreal. I had fully anticipated going into school that I would be a lawyer. At the end of it,
Oh,
that I would go to law school. I applied and got accepted to law school. But in my journey, I decided to take business classes. My father is an entrepreneur. I decided to take those classes. I thought it can't hurt even if I go into law. And I
right.
took finance classes. In derivatives classes, to me really just just hit me right where my interest was. The complexity of the products, the math behind them, and just the various ways you can express views and get asymmetric payouts. So my entire career since has been focused on derivatives. And I started out advising large institutional clients on how to manage exotic option portfolios. This was pre-crisis. People were doing some funky stuff back then that they don't do
Yeah,
today.
which crisis are you talking about?
The GFC,
Okay.
global financial crisis.
Yeah,
So,
we're going to have a list.
yeah,
Anyway, so
exactly.
all right, so wow, what an interesting time to do it because that was the underlying problem were
That's
the
right.
derivatives, CMD, whatever they were, all those derivatives on mortgage loans. So you cut your teeth in a historic period. Uh,
Well, I got the product knowledge at that period, but I didn't really understand the macro. And so that's why I went to Chicago to do my MBA there, University of Chicago. Was fortunate that it was the timing was, get in 2008, right as Lehman,
yeah,
went under. And that's where I was really able to marry the two together, my product knowledge with more macro knowledge. From there, I went to cover hedge funds at Credit Suisse on the interest rate sales desk, did that for a few years. I joined, another broker dealer for a year. Finally, I moved to the buy side and was more focused on, trading, implementing the strategies that I had been recommending to clients. And so what I do at a high level is, I'm a constant studier of the macro environment. That is 60-70% of what my time is spent doing research. That's what I do in the Substack is publishing, the research and notes that I do. And then I look to the derivative markets to see where do I have an edge to express this.
Yeah,
And so, I'm not in markets at all times. I don't have to be permanently long equities or permanently long XYZ. When the opportunities are there, I really want to jump in. And if you can make 3x or 5x on these trades, it more than makes up for when you lose, when you're going to lose just as often as you're going to win. But if you can get these payouts where, your wins are a multiple larger than your losses, in the end, you end up with a high Sharpe ratio strategy. And so that's what I try to do in a nutshell.
okay. Well, I've seen you do it already. Nice call on Bitcoin. So you were looking for the break in Bitcoin, Danny. What instrument and what analysis took you to that conclusion? And did you trade it by, different ways to skin a cat with Bitcoin? How did you go about it?
So with Bitcoin, I've always been a skeptic. Okay, and I've been someone that looked around at Bitcoin for many, many years, and I could not define its purpose. And the purpose kept changing, in many ways. People were sort of fitting narratives.
Yeah.
I have been of the belief that the biggest the issue with Bitcoin is the supply of the entire crypto aggregate universe.
Okay. So
And
all the
so
alts and Ethereum, the minor
everything.
leagues, everything.
Everything.
Okay.
Because Bitcoin has a theoretical limit of 21 million. No one knows when we approach that limit if that'll get raised or not to incentivize miners to keep doing what they do. We'll see.
Yeah.
But they have a theoretical limit of 21 million, and it's held to this day that we've never surpassed, that limit. So that gives people the view that Bitcoin is scarce, right?
Right.
Scarce like gold. There's a limited amount of gold we can pull out of the ground. But the aggregate crypto universe, which includes coins that are, some of them are functionally identical to Bitcoin. They copy Bitcoin, and Bitcoin is open source code, so they can do that very well. This tends to accelerate the supply of aggregate crypto when Bitcoin is in a bull market. And like we saw in 2022, when you have a bear market, that supply ends up being destroyed or removed from the system. And this was an added element that I decided to add to my model to see, one, I think it's a speculative asset. So I think let's use a factor like, QQQ or the NASDAQ. I think it does well in money printing environments. Most people believe that as well. And so you could look at global money supply when it's expanding. That tends to be
Yes.
good for Bitcoin. But the third factor, which is our sort of secret sauce, is the supply factor. And so, in the run from 70,000 to 110,000, supply has started to come up, and it's, all kinds of comedic names like, fart coin
Oh
or
yeah, I was going to ask if you bought the Trump coin. It was
I haven't
11,000%, and
I haven't
yeah,
tweeted any of those,
eh,
but
eh,
as the
yeah,
supply increases, it's been creating vulnerability to it. And my model last week when we were at 96K was saying 86K is fair value.
yeah.
Today it's saying 87K is fair value. So we're at fair value. There's no signal today.
Okay.
But I've started as a skeptic having this model and this model to effectively be a trading instrument. It's not a buy and hold story
Yeah,
for
you're
me.
you're not a hodler, right?
Yeah,
It's just another chart with a different title on it and different beta.
that's right. Yep, exactly.
Okay. All right. So you prepared something for us. I really appreciate the energy and effort that you put into this presentation. Most of my guests, we just talk, but I looked at the deck and we have some important things to talk about. And because, I read your stream, there's, what like Danny thinks crowded trades that you should not be in at this time is China longs, dollar shorts, which I'm not anymore, gold longs, which I've been, selling, and vol shorts, which it's obvious why. So, you know, there's some great actionable narratives that you give people. You know, it's up to them to find entries and their risk parameters, and you probably help them with, you know, when you get to fair value or you're over fair value or under. But you're not just an analyst, you're a trader.
Yeah, I'm a trader and you know, look, I obviously provide clients with, you know, directional advice on trades. What I did with that tweet was saying we had a bit of a shock on Friday with the PMI release that indicated stagflationary conditions. That created a bit of a VAR shock. We've had very confusing markets for the last few weeks. And as a result of that, you know, what ends up happening is the popular trades, if you're sitting on gains, I just was advising
Take
people take those gains. I wasn't advising go the other way and
right.
whatnot. But what I was saying is, you know, look, nothing goes on forever. What goes up goes down. If you're sitting on gains, those tend to be what gets monetized in those events. So, you know, I thought that would be, let me see if I can, I don't think I shared properly. Here,
Charts of the week is up.
do you see it now?
Charts of the week is what I see. February 26,
Okay,
2025.
great. So
Yep.
let's just go through, you know, at a high level where I think we are here.
Okay. Appreciate it.
So one of the things, you know, that first of all, coming into this year, which is a handoff from Biden's administration to the Trump administration, is we've had pretty good economic momentum. Not only a strong economy with very low unemployment rate, 4% in the most recent report. Inflation is obviously above target. GDP, nominal GDP is, you know, in the 5.5 range. But we had some serious optimism from the Trump agenda that lifted small business optimism and other things. But what I wanted to, you know, highlight in this chart here is, I think, very, very important. The economy, you know, is subject to capacity and constraints. Okay, and so I focus a lot on demographic analysis, which tells you that capacity of the economy. Most people think that potential GDP, including the Fed, is around 2%. For 2 years straight, we've been growing 3% on real GDP basis. And that didn't lead to overheating risk in the last 2 years. But I think that part of that is a misunderstanding of what has been the biggest driver of this economy has been, biggest driver of you know, growth in many sectors has been the huge labor supply shock that we got from this immigration story. So if potential GDP is a function of the growth in workers in the economy, for 2 years, we raised the potential of the economy from a 2% range to a 3% range. So
Because of all the illegal immigration.
that's right. You know,
Okay.
and just simple, but more bodies, more productive capacity of the economy. And for 2 years, as we grew at 3%, we were growing at potential, but it was not a real potential. It was a temporary factor, right? And now that immigration has slowed substantially, as you can see in this chart, potential GDP is actually back to 2%. So nobody has a crystal ball on how GDP will be over the course of this year,
Yeah.
but if it continues at a 3% sort of range, we are growing well above capacity and we can overheat. So if we continue growing 3% for the next 2, 3 quarters, we will overheat in the economy. And I think this is the biggest story people are missing. You can look at this. The Fed has their own measure of potential GDP, and you can look at how GDP relative to potential has been over many decades. Since the 1980s, we have not been this elevated relative to potential. Now, of course, like I just said, the last 2 years, we had a temporary boost to potential, but that has entirely faded with the immigration story reversing. On top of it, we have pretty solid momentum. This is consumer spending in the GDP. You can see 4 straight quarters. This has gone up. Savings rates have moved lower. Consumers are confident that their jobs are safe and they're spending money.
Yeah, they don't know about AI yet.
Well, we'll have to see on that.
Yeah,
But some of the, and the Trump agenda, like I said, has led to some optimism and animal spirits in the economy that parts of the economy that have been dormant for 2 years
like
are picking up.
manufacturing's been in the toilet.
Manufacturing, here's the ISM was
Yeah,
below 50 for 2 straight years. Now
yeah,
it's above 50, and new orders is the leading indicator within this, sharply higher. Now, some of this may be front-running trade wars, but sometimes front-running trade wars can lead to a new momentum in the cycle, and that can persist. We'll have to see how it plays out. But this is rebounding pretty strongly and is a very cyclical, sector. Now, the point I made about, the supply side of the economy with that labor force shock is that supply is actually decreasing, but demand is improving at the same time. This is why the labor market is tightening really, really rapidly. Here you have the 3-month moving average of payrolls, 236K. If you take away the crazy years of 21 and 22, you see that that is actually a very strong level of growth and has accelerated, relative to the capacity of the economy. In fact, is actually understating the job growth of the last 3 months because weather detracted between 80 to 90K from the last report
okay.
based on estimates from the San Francisco Fed.
Well,
So the labor market can tighten really rapidly from both of those two factors. Again, I just want to highlight
the
3%.
deportation, the
Yeah.
deportation. Okay,
Well, at a minimum, we don't have the flow of immigration goes to zero, right? So even at zero, it's no longer a contributor. If we have deportation, which so far is quite minor, that's an even further tightening in the labor supply.
okay.
On top of the fact that demand has improved, capex has been very strong. Intentions. This is the spending plans across various measures. Capex,
Nvidia,
yeah, and I mean, there's huge AI announcements. There's 320 billion from four tech companies, Apple adding another 150 billion a year. We're talking about a material amount of capex being spent. Now, if you contrast this with 2018, 2018 was Trade Wars 1.0. Trade
right.
Wars 1.0, it fell off a cliff. And one of the reasons I've highlighted that it could be different this time in Trade Wars 2.0 is that it's not a new policy, right? Tariffs had not been used in 80 years. They've come out and been quite clear about it. Some of the tariffs are still in place from 2018, and
Yes.
businesses are much more familiar with adapting their supply chains. They had to
It's
do
in
it
the
with
it's in
COVID.
the market.
That's it.
So
So
so any announcements when these tariffs go into effect, if people are short-sighted, they're going to be you know, buying bonds because they're actually the picture that you're painting, Danny, and it is contrarian to a lot of people. I'm hearing from some smart people there's going to be a growth scare in April, that there is slowing. I know you have your finger on the pulse. Aren't you hearing that being more of the majority narrative that people fear slowing more than overheating?
they do. And again, I think they don't understand the supply side of the story. If we slow from a 3% GDP to 2% GDP, it's almost like nothing happened. We'll be continuing the way we were in 2024 and 23. Whereas if we keep growing above it, and it looks like we're still tracking above it, we will overheat. And that's the issue is that I think the Fed and the general marketplace and macro in general are very unfamiliar with demographic factors, don't spend time on it because they don't feel like it gives them an edge in the short-term trading environment. But when you understand these big picture, dynamics, it is very important. But there is a concern, and I'm not going to give you the complete rosy picture. And the concern came out on Friday. And what is that concern? The services PMI collapsed. Okay, so you can see here the services PMI. This is the S&P services
Right.
PMI. Has been growing very strongly, in particular since the summer. That growth scare we had was around, here and then we
Yeah.
accelerated sharply with the optimism in particular for Trump economy. January fell because of weather, but the February fall is very concerning. It's the first one that we're below 50 in over 2 years. And if you read the commentary, what were they saying? They were saying the uncertainty over trade is causing businesses to be cautious here. And that is a big concern. So if we do have a growth scare, it's from the surveys turning into hard data being weaker. And so let me kind of just return to this chart for a second. In 2018, like I said, we don't know tariffs policy. Our supply chains are all concentrated in Asia, in particular China. They're at risk from the trade wars. And trade wars is so uncertain because it's happening at tweets in the middle of the day or in the middle
Yeah.
of the night. We don't know how to adapt to this. We're going to pause investing. We're going to pause hiring. That
We
caused
need
us.
we need clarity, is
We
what
need
you're saying in
clarity.
your stream. Okay.
Businesses hate uncertainty. And in 2018, we had that. My expectation was we would avoid that this time around, which you see in things like this. That being said, in the last few weeks, the trade agenda from the Trump administration is all over the place, right?
Yeah.
So first we thought January 20th, we were going to get on Inauguration Day some announcements. Then nothing happened. That
Right.
night, they released a memo. We're studying China. A few days later, Canada and Mexico are hit with 25% tariffs. And then a few days later, we granted them an extension and said that's not going to happen. Nobody really knows what's the success that Canada and Mexico have to, complete to avoid these tariffs coming on altogether. So
Right.
that uncertainty is hanging over everyone. And then, then you have, other dynamics on tariffs being discussed in the media constantly. We're going to do universal tariffs, which would be very hawkish. Then they turn to, we'll do reciprocal tariffs, which
Right.
could be hawkish, but at the same time opens the door for everyone moving to zero at some point down the line, right? If you're 10% tariff on cars and I'm 2.5%, that's like basically Europe versus the US. And I move up to 10, well, why don't we have a conversation and both go to zero, right? And that would be a huge GDP positive. So this got people optimistic and why they sold the dollar. And then you get to, no, but now we're going to include non-tariff barriers like VAT taxes, which would be very, very hawkish and probably be major negative to global GDP. The point I'm making is I think the business sector can deal with tariffs if they know what the policy is. But when you have policy uncertainty spiking like it has in the last 2 weeks, you really can't have that clarity.
Look at that.
So the
Yeah.
problem is we don't even have the tariff policy in place. We
So
don't know
and the last
what
time
the
we were
goals are.
here was COVID.
Right. And so,
And there was plenty of uncertainty there.
yeah, and you can see we're well above the 2018 experience, right? So
Yeah.
I think whatever the tariff policy is, or as hard as it is, there's a trade-off here, right? So what Trump is trying to achieve is we're going to have to inflict some pain in the short term in order to reorient the economy towards onshoring domestic production. That would be a positive if he's successful at it. Businesses are able to say, we'll look through this for the down the line. And households can also look at it and say, we might have a little bit more inflation, but if it brings back manufacturing and reinvigorates the middle class, it'll be worth it. And I just think the Trump administration, they're doing all this television interviews, but they're not explaining their goals. They're not explaining, what the policy is going to be. And this uncertainty is what caused this survey to collapse. And again, I want to kind of caveat that doesn't mean it has to turn into a slowdown. They could come out tomorrow and this uncertainty comes down if they illustrate their plans a little better.
Do you think do they know their plans? You ever ask yourself that?
I think if you really put me under the gun here, I think they're throwing darts at a board to see what the market reactions are to then come up with the final plan. And they're kind of playing a game of 4D chess with the markets. And I think, they don't want the economy to crash. I think they're smart enough to see that the reaction to this uncertainty has been bad. I do think they'll get their act together. I just don't know if they'll get it together in 2 months or if they'll get it together in the next week, right? Like, and that
Right.
could cause a little bit of a growth scare, like we've been talking about, and that's what the markets have been worried about in the last week. Now, there are other things as well,
Yeah, I
Doge.
love this. Go ahead.
Doge to me is a complete distraction. The House just passed, the additional tax cut extension last night. That doesn't mean it's in law yet, but they're going to be expanding the deficit. There's just no way they're not expanding the deficit. If they want to shrink the deficit, you can,
There
hike
wouldn't be
taxes.
tax cuts. There
There
wouldn't
wouldn't
be
be
any
tax cuts.
tax.
Yeah, you would let them sunset, you would let them expire, you would cut some spending from entitlements, maybe defense. There's things you could do or raise taxes. You're not cutting taxes or extending the tax cuts if that's what you want to do.
They're going to go after Medicaid is what people are thinking.
I guess we'll have to see.
Yeah.
The House and Senate have different views on this stuff. So
Yeah.
either way, the deficit is widening, not narrowing. I'm high conviction on this that Doge is a sideshow. And why are they out there talking about Doge every day? They were saying 55 billion in savings. The Wall Street Journal did an investigation. It's 7 billion of savings. Doge's estimates themselves have gone down over time, as you can see in this chart, which is great from their report. You can see that the deficit itself has not been cut in any meaningful way. You can track 2025 versus 24; it's higher. So yeah, and this doesn't include interest expense, which is a big driver these days. And so I think it's a sideshow. Again, I go back to that 4D chess mentality where they're trying to convince you that the deficit won't expand so that the 10-year yield goes down and
Yeah.
their budget passes. But this is a dangerous game, in my opinion, because as time passes, we'll see the deficit doesn't go down. And as time passes, we'll see that tariffs are indeed inflationary. And both of these will come with a more violent reaction in the bond market if you frankly are misleading the public or being a politician rather than an economist, so to speak. Here's the deficit under this was from a good independent nonpartisan agency, and they did a simulation. So even if you assume 2 trillion in spending cuts but you extend the tax cuts, here's your deficit to GDP. It's going to continue widening, not narrowing. And so, the fact is, nobody's really wants to deal with this problem because it comes with an economic contraction. And I don't believe Trump wants that. And so, again, Doge is a sideshow. This is the real story. I don't see material deficit tightening.
Is Powell willing to take the medicine, Danny, before he leaves?
That's the $1 trillion question.
Yeah,
Let's
it is.
focus on, if the labor market tightens, even in spite of some government layoffs and whatnot, that might take a few months to sort through. Then I think, if we have an unemployment rate below 4% by mid-year and inflation is sticky and potentially even higher, the Fed may lose their patience. It remains to be seen because they have
And tighten and
and
tighten.
Titan, they have a dovish bias. We know that. But I think slowly the charade around their dovish bias is, being exposed. And why is it being exposed? So here, first of all, even before Trump's policies, we have sticky inflation. This is monthly core inflation going back to the beginning of 23. And what you see is there's always a seasonally hot period at the beginning of the year, and then there's a seasonally weak period. And the funny part is the markets get super excited about this seasonally weak period, and that's what got us rate cuts. But if you actually average the monthly prints over 23, they were 0.3 month over month average. If you average them over 24, they were 0.3 month over month average. What that means is annualize that, it's a 3.6% core inflation trend rate.
Way
And we've
above
made
their
no
target.
progress in 2 years. We
Yeah.
did make progress from 22, but we have not made progress in 2 years in the underlying trend of inflation. Here's a
Danny, I know you were a young guy in the
Mhm.
70s, maybe not even born. Were you
Not
born?
born. No.
So Volcker is just ancient history to you. But
Ancient
during the
history.
but during I know you studied it, that there were three separate times the Fed thought they had two, that they had beaten inflation, and all it was a pause, and then inflation moved to a higher level and they had to hit the brakes again, and then they paused, and then they brought in the great liquidator who finally killed it. But
And they did cut rates. So in 1969 we had a wobble in the labor market due to protests around the Vietnam War. And this led to them concluding that the entire labor market was on the verge of collapsing. They cut rates. This was the Arthur
Arthur
Burns
Burns, yeah.
mistake number one, was cutting aggressively in that period. But if you look at this chart, this to me is an absolutely insane chart. This is monthly core, so the same as I showed here, but going back to the 90s. And you can see, yes, the pandemic was unusual, but we just got a core monthly print of 0.45. We have not had a zero point 0.4 in any month since 1995.
That's a
Okay, so
big deal.
whether you believe it's seasonally hotter in the beginning of the year or not, we did not have seasonally hotter periods that were zero point 0.4 in multiple decades. We are clearly in a higher inflationary regime, and the markets seem unwilling or incapable of addressing that, in my opinion.
Well,
Now,
isn't a factor, and I know I'm cutting it off because I want people to have an understanding. In your stream, you brought up things like coffee, and
yep,
and there are commodities. The Fed can't print corn
no.
or soybeans. So, and they've been weak for a few years since the invasion of Ukraine, and they're all basing out and coming out of here. So, if we have sticky inflation with weak grain prices, what's going to happen if we have a bull market, some bad weather, and food prices mainly are out of the purview of central banks? Although Volcker did tighten in 1980 while corn was in a bull market to finally even break the corn market. So is that the problem, that this is outside of monetary policy? It's more about Mother Nature and supply from that?
Well, I think the issue is, anything like food inflation is the chicken and the hens and the eggs story with the bird
Yeah,
flu is an example as well. And
yeah.
that's like 140% in 12 months. But the issue is, on its own, the Fed should ignore these things. But when you go through 4 years of inflation, like we've still had 4 years of 3% or above core inflation, and we're getting these supply shocks far more regularly than we used to. And so it's a sign that we're in an inflationary process. And the concern for the Fed is supply shocks unmoor expectations or unanchor inflation expectations. Because yes, the Fed can't do anything about eggs in particular or corn in particular. But what they can do is recognize that the longer this goes on, the more expectations get unanchored. And I'm going to show you some charts on that in a second that I think are interesting. Now, that is supply inflation. The big concern has to be demand inflation. Demand inflation, the Milton Friedman, famous phrase was, inflation is always and everywhere a monetary phenomenon. And, that comes from credit expansion. For 2 years, we've had basically negligible credit expansion in the economy because of the regional banking crisis, which curbed lending substantially. And we were growing due to high wage growth and incomes, as well as the wealth effect from asset prices. But if you get demand-based inflation pick up, then it is a major concern. And so when I look at something like this in December, consumer credit had the largest monthly increase this is in billions, ever. Now, of course, you can't compare billions to like 2000, but you can compare it to 21 and 22, and we are larger on a monthly basis than there. Now, it's just 1 month. You need to bundle these together, but if that is a sign of things to come, then we're in big trouble on inflation. And I think this was very concerning to see how sharp that was. And remember, that was because people are very optimistic about the economy. Lending standards have been easing, and the demand for commercial loans has been increasing. And so, these are loosely overlaid charts, But if you see, for example, bank credit has been growing at 2.5%, which is, negligible. If that goes up where this chart implies to something like 7.5%,
That's
again, then you get
weakness.
consumer borrowing goes up, business borrowing goes up. Then you have that sort of monetary induced inflation. That's the type of inflation the Fed typically acts against because early in a cycle, they encourage credit expansion and then they have to tighten policy when that gets a little bit, faster than they're okay with. That's sort of an early cycle dynamic that we may have in front of us is that lending could take off. And in the 1970s, what you did see is because inflation was eating into people's real incomes, lending would compensate for that. And you had sort of this doom loop where I need to borrow more to pay for everyday items like gas, gasoline or whatever, because they're so expensive. I'm going to borrow, and you get this sort of doom loop. The Fed will desperately want to stop this if this does pick up.
Well, couldn't part of the consumer credit explosion be the kind of people who are, maxed out and need their cards to live on because their liquidity isn't good or the inflation is eating into what their disposable income is, and they're desperately buy groceries on credit cards.
Some of the December increase, we haven't gotten January yet, but some of the December increase was credit cards, but not all of it. So it was other
Okay.
type of borrowing as well. And again, even the business side of things. So, it's still only 1 month. We have to monitor this over time. But, here's the lending from the bank side. And, this great chart here, and you can see, it's been picking up, since the Fed cut rates, it has picked up substantially. And so when the Fed says that their rate cuts are not responsible for the 10-year moving higher, I think they're completely ridiculous to say something like that. When this is the response, it was clearly happening, due to their rate cuts and the Trump optimism story. It's hard to disentangle the two, but both happened at the exact same time. And lending has picked up. And you can see that in small banks, you can see that in large banks. It's a pretty broad-based pickup, and that has to be the concern. And so when you look at some of these inflation indicators, they're all picking up too. These are the prices paid measures in a few regional bank surveys. They're all sharply higher to start this year. Some of it is tariffs, some of it is what I just mentioned above. It's a whole cocktail of factors, but they're seeing this go up. And I love this chart that was shared by Nordea Bank, which looks at the Empire manufacturing versus CPI, and it implies we may have a 4.5% type of range if this materializes. And I think these are concerning signs that inflation is bottoming and potentially making a recovery here. Again, I also go back to the labor market tightening from both demand and supply factors is part of the story. And then last but not least is inflation expectations. And so this is what I was talking about. If these egg prices and other dynamics and then now tariffs get imposed on
Yeah.
all the everyday goods that people buy, and that just leads consumers to say, I expect inflation to be higher. Well, that's what gets the Fed worried. Those two factors, the lending side and this side. On its own, tariff inflation, they may be willing to look through it. But I've been sharing this chart, and it baffles me that people don't look at this. So in the University of Michigan survey that we get, and we got on Friday, a concerning one, people look at the median. The median, as everyone in finance knows, just tells you half the measures are above and half are below, right? So if we have a 3.3 or 3.2 median long-term inflation expectation, that just means half are above and half below. But from an information content value, I want to know if the ones below are clustered at 3.1 and if the ones above are at 10, right? And the median wouldn't tell you that. It would just say, 3.2. And so the average expected inflation is very concerning. Look at this chart. I
Yeah.
mean, the
6.
long-term average is 6.6.
Yeah.
And you could see that this was going up well before Trump won. It's not just like there's people who say
Right.
it's just a political survey. And sure, but it was a political survey this whole period too. It was a political survey when Biden was in office and it started spiking in the summer. And, it took another leg, lately as well with the tariff stuff. And so, if I'm the Fed, I have to be very concerned about these things. And I think they're a little bit lackadaisical about them. And we got another one yesterday. Here's the conference board measure. And look, where is it? 6. So it's not that unusual for this one if we have the other survey also giving us this one.
It's like
So
confluence of economic indicators.
so what got everyone scared last week was, okay, inflation, we're familiar with inflation. It might be flaring up a bit. The Fed, as long as they're not threatening hikes, I think risk assets are kind of okay with inflation. But occasional wobbles on a CPI release day or whatever. But for the most part, I think they're okay with inflation as long as the Fed doesn't tighten. But I think the problem is the Fed should be at a minimum opening the door to that. And if they do, maybe they don't need to hike rates. But the concern from Friday was inflation expectations are going up. Prices paid, all the forward-looking measures are going up. And then you had like that services PMI output, business output, and business confidence collapse. That's a stagflationary condition. Again, it doesn't have to play out that way. It's a soft survey. It's not a hard data. But that's I think what's led to this little mini freak out in the last week, although today seems like people are healing a little bit.
Okay. Wow. What a presentation, Danny. And you say gold has to die. What would make gold die?
I just think it has been for full disclosure, I didn't nail the bull run. Okay,
All right.
there are a lot of people who did. I didn't. So you can immediately dismiss my comments if you feel like it. But I'm
I
honest
don't
when I
do
get
that.
something right or when I don't get something right. I didn't lose money on
Cool.
gold, and I didn't
Cool.
make it. But the thing is that gold has been given these magical properties that it hedges everything under the sun. It
Yeah.
hedges inflation. Well, it didn't in 21 and 22. It had a pretty nasty 2 years. It hedges equity markets. Well, look at the last 2 days. It was down sharply when equities were
Right.
down. In
Right.
August, it was down sharply when equities were down. In, other bear markets, it's been down. So, people assign these magical properties to it when I think the real story has been central banks
Right.
are recognizing that, the dollar regime is more complicated for their reserves. We have a confrontational president in terms of trading relationships, foreign policy as well. And treasuries have proven to not be the safe haven that they used to be over the last 3, 4 years. And gold has been a reserve story. And it looked to me like we had a blow off top due to that delivery of gold, the
Oh,
COMEX
yes.
delivery story. That to me looked like sort of the blow off top. And it's just crowded
Yeah,
and
it
due
is crowded.
due to a correction. It doesn't mean it's the end of it, but my point is if everything else that's crowded, bonds rallied, 50 bips in 2 weeks.
Yeah.
Equities had a 3% correction. The dollar got, crushed pretty hard in the last
Yeah.
few weeks. If everything is going through these sort of rolling corrections and sort of a VAR shock hit,
Yeah.
then gold is next in line.
Danny, Diane, I tell you, it was a lucky day when I saw your tweet and said, let's have a conversation. I encourage people to go to your Substack and at the minimum follow Danny on X because I'm not the only one looking at his stream. He's well followed, well spoken, and you know what you are now after an interview with me, Danny? My trading warrior brother.
All right, I like
You're,
it. Well,
you're
no, thank you so
yeah.
much for having me on the show. I'm glad that we got to chat, and I hope to stay in touch and have
Uh,
come back soon.
Danny Diane, everyone, go to Substack and pay attention to this man. I know after 5 minutes if someone is adding value, and Danny did it for almost an hour. So thank you again, Danny.
Thanks,
Good hunt.
Dale.
Good
Take
hunting,
care.
buddy. All right,
Bye.
that's a wrap, everyone. It will be it's recorded also. So if you missed it live, it'll be up. Adios. And remember, don't just count your economic indicators, count your blessings.